Secondary listing without public offer. One of the key provisions in Chapter 5 is the ability for companies to conduct a secondary listing without a public offer. This option is available to issuers that already have their securities listed in a jurisdiction outside of the IFSC. These companies can list their specified securities on a recognized stock exchange in the IFSC without needing to raise additional capital through a public offer. For a company to list its securities in a IFSC without a public offer, the following conditions must be met. 1. Filing a listing application. The issuer must file a listing application with the recognized stock exchanges in the IFSC. The process and format of this application are determined by the specific stock exchange. 2. Compliance with listing requirements. The issuer must comply with all the listing requirements of the recognized stock exchange and any additional conditions specified by the IFSCA. By allowing companies to list their securities without a public offer, the IFSCA enables them to gain access to a global investor base, improve liquidity, and enhance their market presence in the IFSCA, all while keeping the listing process straightforward and efficient. Listing with the public offer. For companies that wish to raise additional capital while listing their already listed securities in an IFSC, there is the option to conduct a listing with a public offer. In this scenario, the issuer, which already has its securities listed in another jurisdiction, can offer its security to the public in the IFSC through a recognized stock exchange. The following provisions apply. 1. Lead manager. The issuer must appoint a lead manager to oversee the public offer process, similar to an initial public offering or follow-on public offering. 2. In-principle approval. The issuer must apply for in-principle approval from the recognized stock exchanges, where the securities are proposed to be listed. Filing of offer document. A detailed offer document must be prepared and filed with the IFSCA and the recognized stock exchange. This document will contain all the necessary disclosures, including risk factors, financial information, and management details. The issuer may reference a recent prospectus or similar disclosures made with other stock exchanges or regulatory bodies, ensuring that duplicative efforts are minimized. Other provisions. Other requirements such as offer timings, pricing, minimum public offer, minimum subscription, allotment, and post-issue reporting will follow the same rules as for public offers under Chapter 3. The regulations ensure that companies raising capital through a public offer in the IFSC adheres to the same high standards of transparency, governance, and investor protection required for any public listing. This includes provision for anchor investors, underwriting, price stabilization, and lockup periods for certain shareholders, ensuring a smooth and compliant listing process. Special rules for dual listing. Indian companies. An important aspect of listing with a public offer involves dual listing for Indian companies. A public Indian company that seeks to list in both India and an IFSC must comply with any additional requirements specified by the IFSCA. This ensures that dual listed companies meet the standards and obligations of both domestic Indian exchanges such as BSE or NSE and international exchanges within IFSC, thereby protecting investors in both markets. Qualified institutional placements. The IFSCA Listing Regulations 2024 also provides for qualified institutions placements. This mechanism allows Indian companies which already have their equity shares listed on a stock exchange in India to raise capital through a private placement in the IFSC. Qualified institutional placements (QIPs) are typically used to raise funds quickly by offering securities to qualified institutional buyers without the need for a public offer. This process is subject to the guidelines set forth by the IFSCA. and the issuer must comply with the following. 1. Eligibility. The issuer must be a public Indian company with its equity shares already listed on a stock exchange in India. 2. Compliance with IFSCA rules. The QIP must comply with all the regulatory requirements set forth by the IFSCA, as well as the recognized stock exchanges in the IFSC. 3. Disclosures and filings. The company must make the necessary disclosures, including providing the offer document and any other regulatory filings required by the IFSCA. QIPs allow companies to quickly raise capital from institutional investors, providing an efficient mechanism for funding, expansion, reducing debt, or financing acquisitions. It's a flexible option for companies that need capital but wish to avoid the more time-consuming process of a public offer. Benefits of secondary listing in IFSC. Listing specified securities in the IFSC offers numerous benefits to companies, particularly those already listed in other jurisdictions. Whether through a secondary listing without a public offer or a listing with a public offer, companies can leverage the global visibility, liquidity, and regulatory advantages provided by the IFSC. These benefits include 1. Global investor access. Listing in GIFT City or another IFSC allows companies to access a global pool of investors, improving liquidity and broadening the investor base. 2. Regulatory efficiency. The IFSCA listing regulations align with global standards, ensuring that companies meet international best practices while benefiting from streamlined regulatory processes. 3. Enhanced market presence. A secondary listing in an IFSC can enhance a company's visibility in international financial markets, supporting its growth and expansion. Whether a company is looking to list its securities without raising new capital or through a public offer, the regulatory framework in Chapter 5 of the IFSCA Listing Regulations 2024 provides a flexible and efficient route for accessing international markets.